Hi, I'm Pattu from FreeFinCal. In this video, let's talk about how to spot market trends, bullish and bearish trends using an indicator known as the Bollinger Bands. So to understand what the Bollinger Bands are, we need to first understand what is a daily moving average. So in this chart, you see the blue line, which is the Nifty Midcap 150, and the blue line is because of the daily trading, it's extremely choppy or noisy, so it's very difficult to spot trend with it. So to spot trends, we need to reduce this choppiness with by averaging. So what you do is, so on any given day, you take the last 200 days closing price of the Nifty Midcap 150 and take the average. So it's a kind of a rolling average of the last 200-day closing price, and that's the black line. You can see it's a lot more smoother, but you can see because there is a delay, you can see there's a 200-day shift in the features, but that's inevitable, that you cannot do anything. So one way to do tactical asset allocation is to look at the price and the 200 DMA. If the price moves above the 200 DMA, that's the blue line, moves above the black line, then it's time to shift some profit away from equity and move to fixed income. And when the blue line drops below the 200 DMA or the black line, then you move back into equity. Of course, the problem is that the price can be above the black line, above the 200 DMA for several months, and you will feel that you have missed out an opportunity for the market zooming up. So in order to correct that to a certain extent, you use something known as the Bollinger Bands. So what are Bollinger Bands? Bollinger Bands are essentially two lines drawn, one above the 200 DMA and one below the 200 DMA. So it will look like this. So the red line is called the top Bollinger Band, and that is 2 standard deviations above the 200 DMA, and the green line is 2 standard deviations below the 200 DMA. So standard deviation essentially means that for the last 200 days, we find out how much each individual price has has moved away from the average of the 200-day price. So it's a measure of volatility. So the black line is rolling average, and the red line and green lines are rolling risk bands. So you can actually, depending on how spaced apart the red line and the green line are, you can find out the volatility of the market and spot bearish and bullish trends. So I'll explain what those red circles mean. So let's say that the black lines, the 2 black lines are the Bollinger Bands, and this is the price. If the price hits the top Bollinger Bands, when the bands are well spaced apart, that means when the volatility is high, that means this could be a this could be a sell indication. And again, when the bands are spaced apart and the price hits the bottom band, this could be a buy indication. That means that the market is going to move up. There are only indications, it may not happen that way. Another way to use the Bollinger Band is to use the volatility. So initially the spacing between the bands is large, so the volatility is high, but then the spacing has decreased. That means the volatility has come down, but the price is moving down. So this means that the market could fall further down. On the other hand, if the volatility is large and then the bands squeeze or the bands come together, then the volatility is lower, but the price is tending to move up. The trend is upwards. When the bands squeeze, then it could be a bearish indicator. If the band squeeze and the price is moving down, it could be a oops, I got it wrong. If the bands squeeze and the price is moving up, it could be an indicator of a bull run or a bullish trend. And if the band squeeze when the price is moving down, it could be a bearish indicator, that is the price is going to fall further. I'll give you examples. Sorry, I confused that. So again, come back to this graph. Look at the red circles here. In this, the bands, both the red and the green bands, have come together very closely. They've squeezed a lot, but the price is moving up. That means that there could be this is a bullish trend right here. Again, here the bands have squeezed down and the price is moving up. This again is a bullish trend. Another example is that look at the recent few months. The bands have been well spaced apart, so the volatility is very high and the price has breached the upper band. So that's a sell indicator for indication for tactical asset allocation, meaning that the market is going to fall down. So currently, if you notice, the volatility has come down. It is reduced from what it was a couple of months ago, and the price is hovering below the second band. So the trend is kind of downwards with the volatility lower. So it could go down further. I don't know, but it could go down further, at least with respect to mid caps. So this is the zoomed up last few months trend. You can see that the volatility was high in May, and then it has come down in December. The price is tending downwards, and the price and the 200 DMA is tending downwards, and the actual price is below the the lower Bollinger Band. It could go down further. That's what this chart tells you, but you need to use other indicators. So one other indicator is the market price to earnings ratio. So if the price to earnings ratio P is too high, that means that the market is overvalued. That is, the investors are paying more than what the market or the stocks are actually worth. And this is the P of the Nifty Midcap 150, and the center line here is the 10-year rolling average. It's kind of moving up. This is the first standard deviation, one standard deviation above the 10-year average, two standard deviations above, again one standard deviation below, and two standard deviations below. For the last 2 years, the Nifty Midcap 150 P has been well above the two standard deviations line above the average. So that is, it has been well above the two standard deviation line, and only recently it has corrected significantly down. We don't know if it will correct further, but the trend looks like it could go down. That's at least in the mid cap space, it could go down. I don't know, so we have to take a call on that. This is the Nifty 50 Bollinger Bands, and here in this case, notice that the volatility was large in May, but it has decreased a bit, but not as much as the mid cap space, and the trend is kind of flattish. The 200 DMA is kind of flattish because the price went down, hit the lower Bollinger Band, and then kind of moved up quickly. In the last few weeks, it has moved up because of lowering oil prices, and things are looking good, and but things can change quickly. So if we look at the mid cap space, it looks like it could fall further down. In the post linked below, I have shown the data for the Nifty Next 50 also. You can look at that. But if you look at the large cap space, it's kind of flat. We don't know what will happen. So it's a little uncertain. But this is how you can spot bearish and bullish trends with Bollinger Band. Of course, the problem is that it is always easy to do it with data because you're doing it in hindsight. But if you do it on a daily basis in real time, it's a little difficult to take calls. But if you want to do tactical asset allocation, you must learn to do it. Of course, even if you don't want to do tactical asset allocation, if you just want to identify market trends without looking at which expert said that, and this expert said that on Twitter, that expert said that on TV, without looking at all those opinions and speculations, if you just want a quantitative indicator of trend, then the Bollinger Band is a very simple and nice way to do it. Of course, you should not use it in isolation. You should use it with other indicators like PE ratio. I have another post on this. I will link that again in the description box. You can look at that. So this is the 5-year average of the Nifty PE. The center line is the 5-year average. One standard deviations above, two standard deviations above, one standard deviation below, and two standard deviation below. Notice that every time that the Nifty PE has moved above the 5-year second standard deviation band, that is the topmost band, which is two standard deviation above, every time it has moved up, it has corrected. So every time it has come there, it has corrected. Again, it has gone up there and corrected, up there corrected, up there corrected, up there corrected. But sometimes the corrections can be rapid. I mean, it can come down then go up again after a couple of months, and you don't know that. But that's so you can combine this. But if you look at the trend of the PE now, it looks kind of going a little bit above. It's going up to the standard above to the top standard deviation band. So if you look at the large cap space, it looks like there's not much of a correction in space for the large cap. But if you look at the mid cap, it looks like it could correct further. So well, it's a little confusing. There's not much you can do. If you ask me what you should do, well, first study these indicators in real time, get used to them. Then only you can take a call whether you should do tactical asset allocation or not. Right? Study them. Just study them. What's going to happen in studying? Right? You don't need to act on it. But if you're investing for long-term goals, don't put money away. And there are many people I know who are sitting on cash waiting for a big fall. I don't know why they are doing that. That's completely stupid. Don't wait for a big fall. You put your money into the market. And when these indicators suggest that the market is overheated, then you must have the courage to pull it out. That many people don't do. They want to wait for a dip and then buy. That's kind of silly. So as long as your goals are far away, there's no problem. Invest as usual. But if you want to do tactical asset allocation, first study these indicators, and then you can get used to them, understand how hard it is to do it in real time, and then you can engage in actual tactical asset allocation with real money. So if you're interested, I can do other indicators on tactical asset allocation. I hope that was reasonably clear. Sorry if I confused the bullish and bearish trends and so on. It's a little when I talk, you can get it mixed up. So I'll catch you again in another video. Bye bye.